Hey everyone, in today's video we're going to talk about 6 Canadian stocks that I currently have on my watch list. Now before getting into it, if you haven't subscribed to the channel yet, please hit that subscribe button in the bottom right hand corner of the video. If you like this type of content, please like the video, and if you have any thoughts on any of these stocks, would love to hear from you in the comments. So if you're familiar with investing in the Canadian stock market, some of these stocks you may have heard of before, some of them you still may not have. So I think this will be a really interesting video and hopefully give you some ideas of things to look into for future investment opportunities and maybe things that you can add to your watch list. The first stock that I want to get into today is a larger Canadian company, Pembina Pipeline Corporation. So this is a stock that is pretty stable. They own pipelines across Canada, and lots of them, I think some of them go into the US as well and deliver, energy and oil, those kinds of products cross border. Now, the stock pays a pretty high dividend, 5%, and over time it's grown, pretty modestly, 3, 4, 5% increases every now and then. But the stock's held up pretty well too. So this is a stock that, I'd feel pretty safe of getting that monthly yield, monthly payout of the 5% yield. I don't have too much exposure to like energy and gas today. So this is one that I've considered buying on weakness. The only thing is in the last little bit with, global energy supply getting a bit more dodgy, the stocks actually had some strength. So I'm used to Pembina being closer to $40, up about 10% versus where there are some opportunities to buy in earlier. So I just need to get over that valuation adjustment. I still think it's a reasonable price. The biggest risk with stocks like this is you never know if there's going to be a big regulation change. If there's a pipeline leak or something like that, it could be catastrophic impact of the environment, and you may be or the company may be liable to fix those kinds of things or pay communities back or whatever it may be. So those are also events that could impact the stock if it happened in a big way, like the BP oil spill back in the day. But overall, this is one on my watch list that I'm really just looking at as a yield play. So I'm really just looking at it as I'll get a 5% return on my capital every year. And as this number goes up, depending on what other opportunities are in the market, that's really what will dictate whether I decide to start averaging in or do a big buy into this company. But for now, it's still on my watch list. Going into stock number 2 is EQ Bank. So EQ Bank they call themselves the challenger bank in Canada. And this stock has done really well as they've gained up a lot of speed, have hundreds of thousands of clients in Canada, continuing to grow their assets under management quarter on quarter. And I think they've increased their dividend now 5 straight quarters as they just continue to get more and more cash flow and growing at a very fast pace. Now, despite this being a bit of a fintech play, since they are mostly a digital bank, they don't really have too many physical locations. This trades at about 7 times earnings. So they do about $2.50 a quarter in earnings per share, so about $10 a year, yet it's only a $70 stock. I actually owned this stock briefly a few months ago when it was in the mid 50s down here, but with no earnings report, and I didn't really get to build up a big position. So as soon as it got over $60, I just was left with this small position that just went up 10% in a month. And I'd rather average down than average up, so I just sold out. Now, obviously, in hindsight, wrong decision. Stock's now at $70, so I would have made another 20% or 15%. But it is what it is. I didn't really have a full built-out position in the stock. Still trading at about 7 times earnings, and they just came out with their earnings a couple days ago. So maybe I'll take a peek at what their numbers were, and I may just bite the bullet and buy in 30% higher than I did before. But this is definitely one that's interesting, and I'll always look at the valuation relative to the bank stocks I currently own, which are TD, Scotia, CIBC. Is this adding something unique to my portfolio? Is the value enticing versus what I can get out of the stocks I already own today? I don't like complicating my portfolio for no reason, so it really has to add something different either from an undervalued point of view relative to the other banks, or what the product is, what the offering is, how they play in the market point of view. Going into stock number 3, so Rogers Sugar. This is a Canadian company, just going back longer term. It's traded at this $5-6 price for quite a while, but they do pay almost a 6% dividend. I believe their PE, this doesn't look right, is in the low teens, call it like 11, 12 times. So they're delivering like an 8% return on their market cap, paying 5 to 6% in a dividend, the other couple percent reinvesting in the business. But they own a lot of products to do with sugar. So just to read verbatim here, products include brown sugar, dry blending, granulated sugar, icing sugar, jam and jelly, liquid sugar, organic sugar. You guys get the picture. But a big part of their business, I think it's like a third or 40% of their business that they merged into a while ago, was syrups. So they own a lot of the raw maple syrup production in Canada. And if you're having a maple syrup that's not like Aunt Jemima or a national brand in Canada, it's likely coming from Rogers Sugar. So that's another part of their business. As I look at this, the valuation's not bad. And that paired with the dividend is why it's on my watch list. But obviously not necessarily a growing category as it pertains to sweets and maple syrup, stuff like that. So it's one that I think at the right price and at the right discount, I'd be willing to buy into it. But it's one that I just look at it for the price. Oops. and if it is attractive enough to, if the dividend's worth it, and if the upside on the price to earnings ratio is there for me to invest. Okay, going into stock number 4, Well Health Technologies. So this is a company that doesn't pay a dividend, but they're a really fast growing company, growing both organically and by acquisition in the telehealth space, where they do a lot of virtual services of software within healthcare, and they sell that to medical offices. They also acquire clinics, so they roll up clinics and they try to derive scale, put in technology across them, stuff like that. They've had a bit of a wild history. If I just look at their stock price, it's not loading for some reason again, but the stock was like a 50-cent stock a number of years ago, went all the way up to $9, essentially up 20x. Then during the interest rates going up, slammed all the way back down to 2. Now it's doubled back up to 4. So this is a very volatile stock. They do pump out a good amount of free cash flow, but they just invest it and keep reinvesting it into the business. So they are gross margin positive. They are relatively financially savvy. And they have even talked about buying back shares, things like that. And they make lots of accretive acquisitions to the business. So it's still in growth mode, but this is really in Canada building one of the top telehealth technology companies. There's lots of them in the US. Realistically, I can see a US company eventually coming in here and buying Well to get scale over the Canadian market in addition to the US market, drive some synergies there as these companies eventually seek profitability or higher profitability. But this is a name that I definitely find interesting as like a flyer. I liked it a lot better before it went up 100% again, but it's still one that I like keeping an eye on. Going on to stock number 5, Empire. Empire, for those of you who live in Canada, owns Sobeys, which owns Food Basics, Safeway, as well as Farm Boy they recently bought. They also own about 50% of Longo's for those who live in Ontario and may do their grocery shopping there. So they are a national grocer under a bunch of different brands. In addition to that, they also own a chunk of Crombie Real Estate Investment Trust. So they do have some real estate exposure still in this equity and in this stock if you buy it. The company traded up pretty aggressively in the 2010s on high growth aspirations, but it's really been stagnant for a number of years now. They're trading, I believe, Yeah, this looks about right. In the low teens, so 12 to 13 times earnings, which is a lot cheaper than some of the other national grocers like Loblaw, for instance, are trading at. So, from a valuation perspective, they look like they're fairly priced. They do have a small dividend of one, actually higher than I thought, almost 2%, and they have increased it over time. So, this is one that depending on the valuation, once again, lots of these are valuation dependent. But if this ever got to the point where it was trading like at 10 times earnings or close to 10 times earnings for a defensive business like grocery, and they also own some real estate in there, I think that's probably an attractive price point to start averaging into the stock in terms of my personal portfolio. Once again, I'm not a financial advisor, not a financial advisor sharing kind of how I'm thinking about these stocks on my watch list. So yeah, this one's one that I think it's a good asset, good business, good company. Um, with that being said, there's lots of good companies. It doesn't mean I need to buy every one, but it's one that if it gets to the point that I feel like it's undervalued, I would start a position in it potentially. And the last stock I have here is MCAN Financial Group. So this company is a smaller company. Lots of people haven't heard of it. About $500 million in market cap, trading at 10 to 11x earnings. And they essentially provide commercial loans, residential loans, construction loans to builders and just everyday citizens in Canada. Um, this stock I kind of like having a proxy on it just to get a sense of relative to some of the other financial companies I own and I'm looking at like EQ Bank and stuff like that, how it's priced and how it's valued. But I don't have a lot of interest in actually buying it. It's at about a 9% dividend yield, but it pays all of its earnings out. So just to compare this to a company like TD, also trading at 10 to 11 times, they pay out half their earnings in dividends, so about half the yield, but the other half of the dividend or half of the income rather is going into acquiring new businesses, buying back shares. So I'm still getting that value in other ways. And I feel like TD's business is a much stronger book on the loan side than MCAN Financial is just by looking at the report. And they have a lot of other revenue streams and a lot more diversification that's a lot stickier and a broader moat. So I don't really see the value relative to the Canadian big banks, which I think are undervalued. And that's why I'm focusing more of my investment on the holistic banks than like a one off mortgage company like this. But I still like, seeing the value that it's deriving on the market and seeing how it is relative to the banks to see if there's ever an opportunity to get a higher return on investment or pay a lower PE and get a higher yield potentially, but not one I'm overly interested. If I was going to look at the ones that I was truly interested in buying, it would probably be Pembina and it would probably be Empire. The other ones I like knowing of, I might buy them, I could buy them, but not really something that I'm likely to jump into in the next week or the next month. EQ Bank is one that could also get on that list depending on how their earnings were, but I think it has to be um, a really good value just because I really already have a lot of banking exposure through those bigger banks. So it has to be enough of a reason to buy this bank instead of those banks and add the complexity of owning another stock to the portfolio. So that's my watch list from my Canadian stocks. Hopefully, you guys get some perspective of kind of how I look at my portfolio, how I look at my watch list and some of these companies. If you guys own any of these companies or have any thoughts on them, please let me know below in the comments. Would love to interact with you guys. And I just want to thank you guys for tuning in and for anyone who's still watching this late in the video. I truly do appreciate it. Let me know in the comments, and I'll see you guys in the next one. Cheers.